the media is finally picking up on this and talking a lot more about it, trying to figure out what it means. And we've been saying for some time that it means that growth and or inflation are going to disappoint on the low side of expectations within the next year. I think that the Fed is not paying too much attention to this indicator because it's looking at backward-looking indicators. So employment and the headline measures of inflation, not the leading indicators. So the leading indicators of inflation are pointing down to deflation, actually.
Cathie Wood, founder and CEO of investment management company ARK Invest, reiterated her bullishness on Bitcoin and other cryptocurrencies in a recent talk at ARK Invest. Wood provided some insights into her investment strategy and outlook for the industry, despite some recent setbacks of the broader crypto macro, like the collapse of both FTX and Silvergate. Wood says she remains bullish. In this video, Wood talks about the general market outlook, from fiscal policy to monetary policy, the leading economic indicators, market signals, and how the Fed is trying to fuck everything up. She also talks about the recent bank runs and reiterated how the bearish stance and economic outlook don't have anything to do with crypto. According to Woods, the government has moved a motion to cut spending in key areas which she believes are very vital, and cutting spending is not a good thing for such sectors. She mentions small businesses, aviation, and the transportation sector in general. She also talks about the intentions to increase tax rates to double and even triple their normal levels. The Fed is fixated on employment as an indicator for inflation, which Wood points out to be a very foolish thing to do, as the data being provided doesn't tally with the real employment situation. Also, as the Fed fights to slow employment down, it is ignoring the major leading indicators of inflation, which she will mention in this video. She also talks about the recent bank runs, the Silvergate, and the Silicon Valley saga. Let us now get into the video to listen to what Cathie has for us. In the meantime, make sure to like, subscribe, and drop your comments as we go. Enjoy.
Increase in spending is $2 trillion over 10 years. I know that the Republicans want a cut in spending over 10 years. So right there's a big gulf. There are three areas, though, that the Biden administration is willing to cut spending. The first is the Small Business Administration. Well, small businesses are the biggest job generators. And I think I read somewhere in mulling over this budget that one of the reasons to this is they want to stop employment or slow it down so that the Fed will slow down. That's kind of interesting. The other interesting spending cut is Department of Transportation. I think I've read about 5 train derailments in the last few weeks, and planes at airports at risk of running into each other, lots of reports of those. So I'm not sure that's the best place to cut, but nonetheless, there are a few cuts in the budget. It'll be interesting to see how the negotiations go. These budget proposals are typically a no-go. They're going to change radically, but I did want to give you a sense of the massive tax increases across the board that the Biden administration is proposing to close the budget deficit. For example, the corporate tax going back from 21% to 28%, a tax on share buybacks of corporations going from, well, they're saying 1% to 4%. So a fourfold increase there. Yeah, 40% increase, roughly 40% increase in the corporate tax rate. But even taxes like the Medicare tax for individuals making more than $400,000 a year, they're proposing that go from 3.8% to 5%. Now, that sounds like kind of a small increase, but that's a 30% increase. And we have other examples of a doubling, the tax on foreign earnings going from 10.5% to 21%. That's a doubling. So We have the tax on carried interest, once again showing up. That's nearly a doubling from 20 to 39.6. So a lot of tax increases, including ones that we think would hurt capital formation. Capital gains tax going from 20 to 39.6%, the dividend tax 21 to 39.6%, a net wealth tax being initiated at 25% for individuals making more than $1 million.
One of Cathie Wood's funds sold virtually all of its shares in Silvergate Capital Corporation after the cryptocurrency-focused bank announced that it was forced to sell assets at a steep loss as customers pulled out most of their deposits during the fourth quarter. Her ARK Fintech Innovation Exchange-traded fund unloaded roughly 404,000 shares of Silvergate on Thursday, cutting the ECA's holdings by more than 99%, according to data compiled by Bloomberg. The fund's remaining holdings, which amount to less than 4,000 shares, are worth about $43,000, only about 0.01% of the fund's total portfolio. As we would see in the next video, Cathie Wood talks about the recent bank runs and the role the Fed played in them. She also talks about its similarity with other bank runs in the past and comments that it doesn't have anything to do with crypto.
But we're beginning to see brewing here a banking crisis. And the question we have to answer, is this going to become systemic like Lehman Brothers in 08 or 09? Or, and we're betting on this latter one here, is this more like 1994 when Orange County went broke and that created a crisis to which the Fed responded? We think it's much more like 1994 because the setup was similar. In 93, 94, commodity prices had taken off as we were coming out of that recession. It was an S&L-induced recession, so housing. And the Fed was railing against those price increases with higher interest rates. It was a terrible year for growth stocks, and that's how we would characterize 2022. But when Orange County went bust, that was a sign that the Fed had gone too far, and the Fed did change its spots. We believe that the failure of Silvergate Bank and Silicon Valley Bank, which just the FDIC put it into receivership today, both of those are telling us a couple of things. One, that, the Fed has gone pretty far and is causing a lot of banks, not just these, difficulties. And I'll describe how in a moment. So we do agree with those who say, well, Silvergate had a concentration of crypto customers, and Silicon Valley Bank had a high concentration of venture and venture-related customers. And so that's all true. But if you look at what has happened here, it is the deposit outflows that have triggered the problem, the crisis. We know that venture capital is facing a bit of a liquidity squeeze. Fewer deals are being done. There is more risk aversion in the marketplace. And so these companies are having to draw down their deposits. Most bank with Silicon Valley Bank. They're drawing down their deposits because they have to. I think what we're seeing today is in some of these banks under collateralization. But in both cases, what do we have going on? These are centralized entities, and they're not transparent. Certainly when it came to FTX, not at all transparent. Centralized, opaque, completely opaque. The banks have to do more disclosure, so they're not as opaque. You could see that they were upside down in terms of interest rates, having to pay up for deposits, but earning a very low yield to which they committed at a bad time when interest rates were very low, thinking they were being smart. And so this is nothing to do with crypto. In fact, Silicon Valley Bank, I mean, I don't think you're going to see a mention of crypto at all there. So it has nothing to do with crypto, but it does have something to do with what happens during banking crisis. Usually these banks are upside down. They start losing deposits. In the case of Silvergate and Silicon Valley Bank, there's a run on the bank. When you get Peter Thiel and other famous investors and well-respected investors saying, get your money out of there, they're going to take the money and run. And so this is nothing to do with crypto. This has everything to do with Fed policy, we believe, taking interest rates up so dramatically, the most rapid rate in history, and taking money growth down from 27% 2 years ago to -3. So that's a 30 percentage point swing. That has never happened. We've gone back to the Great Depression to see if that was the case back then as well. It wasn't.
In other news, Circle Internet Financial's USDC stablecoin, which is the second largest stablecoin at $42 billion of market cap, depegged from the US dollar as contagion from the collapse of Silicon Valley Bank spreads. The USDC or USDT trading pair dropped as low as 0.94 cents on Kraken, the lowest price since April 2021. It recovered to about 0.984 cents as of 2:54 UTC on Saturday. USDC is meant to maintain a 1-to-1 peg with the US dollar, but worries about the impact of Silicon Valley Bank's failure drove it down from $1 on Friday. An undisclosed portion of USDC's cash reserves is parked at the now-failed bank, leading to concern that money backing the stablecoin is now stuck. Stablecoins like USDC are a key part of the crypto industry's foundation, and when they stray far from $1 or whatever fiat asset they're pegged to, that suggests concern about their financial footing. Circle tweeted that everything is normal with the coin and the dip was a result of the Silicon Valley Bank, which is one of his partners. Bank runs, the crypto market plummeting, rising interest rates, expected monetary tightening, etc. So much bearish news regarding the economic outlook as the days go by and little is known of the path forward. What do you think of the gloomy state of the market right now? Let us know in the comment section below. Don't forget to give us a like, subscribe, and turn on post notifications. Thanks for watching.